about 30 years and a CPA for about that long, and I've got great ways to explain accounting. Today we're going to do example number 2, Introduction to Financial Statements. This lesson is for principles of accounting, introductory accounting, maybe your first week or two of accounting. So here we go. So what we have Fred Snowblower Service, and Fred Snowblower Service had a lot of transactions during the year. And I've got all the transactions listed right here. So what we need to do first of all is go through them and find out, well, what kind of accounts are these? We only have 5 different types of accounts. We have assets, liabilities, equity, revenue, and expenses. That's it. And as we hit these different accounts, I'll explain them. So first of all, we've got delivery expense. And delivery expense, the name gives it away. It's an expense. An expense is a cost of doing your job. Fred's job is to fix snowblowers, to sell snowblowers, and delivery expense is a cost of doing that job. Now, accounts receivable is an asset. It's a nice thing to have. That's our definition right now of assets. Nice things to have. And it's nice to have people owe you money rather than the other way around. Cash. Who does not like cash? Cash is an asset. Accounts payable, that is a bill. It's money that is owed, so we consider that a liability. And marketing expense, that's a cost of doing his job here, Fred's job. So here we go, an expense. Common stock is equity. Equity, so what is equity? Well, the accounting equation is assets equals liabilities plus equity. So if we just rearrange the equation a little bit, we have assets minus liabilities equals equity. So it's whatever's left over. And it represents the owner's interest in the business. So apparently, Fred has $100,000 of common stock. Tax expense, another cost of doing business. Building, nice thing to have. So we'll call that an asset. Coming over here, repair revenue. Repair revenue, that is money coming in from doing his job. Now, folks, even if this is your first or second week of accounting, one thing that you have to get straight is that revenue is money coming in from doing your job. You have to do your job before you can claim revenue. You cannot claim revenue before you do your work. Remember that. A lot of people go to jail for this, and I'm serious. They go to prison. So you don't want to get this wrong. It's the number one form of fraud, folks. Rent expense. Well, the name gives it away. It's an expense, a cost of doing Fred's job. Wages payable. That's a bill. It's money owed. It's a liability. Office supplies expense. It's an expense, cost of doing business, using up those staples and paper and pens. Wages expense. Here we go. That's cost of doing business. Now, so what's the difference between wages payable and wages expense? Well, wages expense, that's money that has been paid to workers for helping Fred fix snowblowers or sell snowblowers, and it's a cost of doing business. Now, wages payable, that is money that is still owed to the workers. The workers have earned the money, but they have not yet been paid. Retained earnings. Retained earnings is also a part of equity. It's also goes kind of hand in hand with common stock, kind of, sort of. Yeah, but it goes in the equity section. Inventory. Well, if you have a snowblower service, it's good to have inventory of snowblowers or inventory of snowblower parts. So that's an asset. Good thing to have. Land's a good thing to have. So there we go. So there's our accounts. I've got a little bit more information right here. The beginning common stock was $75,000. So apparently it looks like common stock went from 75 at the beginning of the year to 100,000 at the end of the year. It looks to me like Fred contributed another $25,000 into the business here. So looks like Fred invested another $25,000. Dividends paid. Fred withdrew money out of the business as dividends. They're the same thing as withdraws, owner withdraws. Fred is taking money out of the business for his own personal purposes, which he should. It's his business, right? So here we go. So what we're doing is we're going to come down to the financial statements, and I need to split the screen a little bit. All right, well, I've got the screen all set up now, and so let's do the financial statements. The first financial statement is the income statement, and folks, you have to do it in order. The income statement has to come first. The reason why is we need to know what net income is so we can continue on to the other financial statements. And so when you're working on your homework, if you see a problem where the textbook says do a balance sheet, then an income statement, blah, 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 don't pay any attention to it. Do the income statement first. You have to do the income statement first. All right. So here we go. Repair revenue. Repair revenue is $1,280,000. So here we go. $1,280,000. There it is. There's only two kinds of things that go on an income statement: revenue and expenses. Money coming in from doing one's job and money going out from doing one's job. So the income statement's really about how well is Fred doing his job. The next one is delivery expense. It comes from the chart right up here. Delivery expense. There we go, $75,000. Marketing expense. That comes from the chart also. There it is, $60,000. Just all you got to do is write it down. Tax expense. Here we go. Tax expense comes right off the chart. $45,000. Rent expense. There it is, $52,000. Office supplies expense, $20,000. Wages expense is a cost of doing Fred's job here. Now, all you do now is add this up and get a grand total. And I hope you're using Excel, because with Excel won't make any adding mistakes. All right. So here you go. Let's see what the grand total is. $1,002,000. So how do we find net income? Net income is just simply repair revenue, money coming in from doing his job, minus expenses, money going out from doing his job, and that is net income. And let's see what he's doing here. So he made $278,000. I would say Fred is doing really, really well. So ladies and gentlemen, we're coming over here to the statement of changes in retained earnings. It's a very simple statement, easy to do. It's always the same. It's really super easy. So here's what we do. Beginning retained earnings. Retained earnings is the amount of money that Fred is retaining in the business. It's the profits that he's retaining in the business to help grow that business. So retained earnings, beginning retained earnings, get it off the chart here, 120 grand. There you go. Add net income. That net income, as mentioned, it just flows right up here like a river. Same number. You don't have to think about it. Minus out dividends of $35,000. We got that off the information right here. There it is, $35,000. And ending retained earnings is simply going to be $363,000. How do we get that? Well, 120 plus 278 minus 35 is 363. So there you go. Now I've got an alternative format. You can see that in the nice bright red letters there, alternative format. And what this is it's just simply what we just did, but a different format. Now, a lot of you might be wondering, well, do we have to do both? No, you don't. You either do one or the other. The reason why I'm including this alternative format is that some textbooks do the statement of changes in retained earnings this way, like we just did it in the green, and other books do it like this one in the pink. So I'm just covering them both. You don't have to do both, but do one or the other. So here's all there is to it, folks. Half of it we already know how to do. Half of it is right here, retained earnings. It's exactly what we did right up here. For instance, beginning balance in retained earnings is 120. So let me drop that down. How do I know that? Well, it's the same thing as the last statement. Add net income. Here we go, add net income. And I've got it in this real nice blue color because, again, it flows like a river from the income statement. It's just that we went up this way at first doing this format, and now we're just doing it in this other format just to cover all the bases. And then finally, subtract out the dividends, $35,000. There are the dividends, and you get the ending balance. There you go. So look, check this out, guys. The ending balance with the first way of doing it is the exact same as the second way of doing it. So again, you don't have to do this 2 times. You just pick one format or the other. And it might be whatever your teacher wants or whatever the textbook wants. Either way, it's pretty easy stuff. So let's fill in the other columns here. Now, common stock, the beginning balance for common stock, we can get that from right here, from this information. It's up here. Beginning common stock, $75,000. So let's just put that in here. There we go. And the ending balance of common stock would be coming right off of here, 100,000. So there's the ending balance. And folks, so what apparently happened here, he went from 75,000 to 100,000. That's a gain of 25,000, right? So it looks like he issued common stock of probably 25,000. There you go. And you don't need anything in the dividends because we took care of that under retained earnings. So that was easy. So the first retained earnings column's easy, common stock column's easy, and the total's easy too. All we're going to do is add horizontally. So 75 grand plus 120 is the grand total. 25,000 plus nothing is 25,000. And nothing plus 278 is 278,000. Nothing plus 35, or add a negative 35,000 there. So there we go. We're just adding across. And then 100 grand plus 363 is, there you go, 463, folks. So either way, either format's easy. There's nothing to it. Now coming down to the last statement here, it's my favorite statement. I love this statement. I think this statement tells so much about how a business is doing. So here's what we're going to do. We're going to just fill in the amounts for the different assets. And if you remember, assets are nice things to have. So cash, how much cash? Get it off the chart, 35 grand. Accounts receivable, 90,000 right off the chart. No thinking required. Inventory, how much inventory did they have? Oh, I must have missed it. Inventory. Oh, there it is. 350,000. So here we go. 350,000. Land, 78,000 right off the chart. And building comes from right there. Building, 200,000. And all you have to do is add it up. And again, use Excel when you're doing your homework. You really need to learn to use Excel. Don't handwrite it out. So 753,000 if you total all up. So there you go. And Excel will not make math mistakes. So there you are. We can tell Excel to do the wrong thing, but it won't make any mistakes. So now these assets are listed in a specific order, in order of liquidity. What does liquidity mean? That means how quickly you can change something into cash. So cash is already cash, so that's listed first. Accounts receivable is pretty close to cash. As soon as the customers pay, it'll be cash. Inventory, we have to sell it first, and then our customers have to pay us, and before it ends up being cash. And then land, we probably won't ever change that into, or turn that into cash, or at least not until Fred decides to sell his business. And the same thing with the building. So these are listed in a particular order here. So coming down to the liabilities, here we are, accounts payable. Let's see what accounts payable is. It's right up there. It is 280,000. Wages payable. There it is. There's that wages payable. Not wages expense, but wages payable. This is a bill. Add it up. 290,000. There you go. And here's the last part of it, stockholders equity. And you know what's really cool about the stockholders equity is we've got all the numbers figured out already. Right here, if we look at this second format, they're all figured out. If we use the first format, we've got at least retained earnings figured out. So there you go. So all we're going to do is copy these numbers down below. So common stock, according to that statement, is 100,000. And the retained earnings from that statement, where are you? Here you are, 363. Here's the retained earnings, 363. There we are. Let's get that blue. And I've got it in blue because it's like the river. It's flowing down to the next statement. So what's happening is this number 363, or right up here, 363, either one. These are the same statement, just two different formats. So that 363 gets transferred right down there for a grand total stockholders equity of, there we go, 463. We could double check our work too, see if we're right. 463 right there. All right, now the last step, guys, last step. You don't want to forget this. Don't forget this, because if you do, you'll be fumbling the football on the 2-yard line, all right? It's like you're about ready to score a touchdown and you drop the football. So don't do that. What we need is total liabilities and stockholders' equity, the grand total. So all we're going to do is take the 290 and the 463, add them together, and see what we get. There we go, 753. And guess what? The 753 balances with the 753 under total assets. That's why they call it a balance sheet. All right. So let me tell you just real quickly a little bit more about this balance sheet. This balance sheet is the accounting equation. It's assets equals liabilities plus stockholders' equity. It's the accounting equation. And assets is all the nice things that Fred has in his business. The liabilities are the bills that he owes. And if you take these assets minus away the liabilities, you get stockholders' equity. And stockholders' equity is the net worth of Fred in regard to this business. It's his wealth in this business. Now, you've probably heard of people that have a net worth of $1 million or something like that, or a net worth of $1 billion. Well, what that means is that an individual's equity here would be $1 million. So in other words, they have a lot of nice things to have, maybe a nice car or nice cars, boats, houses, whatever, a lot of nice assets, minus away what they owe, and you get their net worth. Now, it can happen where somebody has lots and lots and lots of nice assets, beautiful cars, houses all over the place, you name it, they've got it. But at the same time, they are drowning in debt. They've got tons of debt. Well, it might be that their net worth is not very big. Maybe their net worth is even negative. In that case, they're not very wealthy at all. They might look wealthy, but they're not at all. So there you go, ladies and gentlemen. That is how you process these transactions. If this lesson helped, hit that like button, hit the subscribe button,